Okay, let's dive in. Today, we are looking at numbers that are, honestly, they're almost hard to really wrap your head around.
They really are.
We're talking about Stephen Schwarzman. He's the co-founder, chairman, CEO of Blackstone. His personal wealth, somewhere around $42.4 billion.
Just staggering.
And his firm, Blackstone, manages, wait for it, 1.127 trillion in assets.
Trillion. With a T.
And get this, in 2024 alone, he reportedly took home $916 million.
$916 million. In 1 year.
These aren't just big numbers. They feel different, seismic almost. They signal something unique about how this whole machine works, don't they?
Absolutely. And what's fascinating looking at the sources is that these figures aren't just, luck or timing or just doing standard things bigger. It seems to be the direct result of a very specific, often quite unconventional and intensely disciplined approach.
Right. It's not the usual Wall Street playbook scaled up.
Not at all.
Okay, so that's our mission for this deep dive. We're going to take these sources, the research, the articles, the nights you've pulled together, and really unpack it. Stephen Schwarzman, born 1947, he's been building Blackstone for decades. Turned it from a small M&A advisory shop into the biggest alternative investment firm on the planet.
A complete transformation.
So we want to get under the hood. What are the actual strategies? What's the mindset, the leadership habits? What's the philosophy that let him build this global financial giant? And why does his name carry so much weight?
Well, we can break it down based on what the sources highlight. There are some key themes that keep coming up. First, there's his almost legendary financial mindset. Think big, bet big, that conviction.
Yeah, we definitely need to talk about that.
Then there's how he actually runs Blackstone. It's described less like a normal company and more like a special forces unit.
Yeah.
Very focused on precision, elite performance.
Interesting metaphor, special forces. Okay, what else?
His philosophy on talent. Who gets in the door? Incredibly rigorous, very discerning. It seems absolutely central to him.
The who matters.
Got it. Then the investment strategy itself. It's multi-layered, deliberately diversified. The sources call it a fortress, basically designed to win no matter what the market's doing.
A fortress. Okay. Resilient.
And finally, we need to touch on his influence. It goes way beyond finance. We're talking government, education, global policy. It's extensive.
Wow. Okay, that's a lot to unpack. It sounds like a really comprehensive picture of how you build something on this scale. Where should we start?
Let's lay the foundation first. That think big, bet big mindset. It really feels like the core of everything.
Yeah, that phrase pops up everywhere in relation to him. It seems almost like a company mantra. There's that quote, when you see a rare opportunity, don't go in halfway, go all in.
And that quote, it sounds simple, but it carries so much weight. It's not just about being ambitious, is it? It's about having the analytical conviction first, and then the sheer guts to commit massive capital when you think you've found something truly unique.
Don't go in halfway. It implies you've done the work, you're certain, and then you act decisively.
Exactly. It's conviction born from deep diligence.
And the sources show this isn't just talk. This philosophy, it's defined Blackstone since the early days. It's what fueled that transformation from the small M&A shop to the $1.127 trillion giant. It's about spotting those moments, those inflection points maybe others miss or are too scared of, and just seizing them completely.
Absolutely. And you see it playing out in these huge, almost audacious moves. The source points to that announcement in mid-2024 as a really good recent example.
Right, the Europe investment.
Yeah. While, much of the investment world was getting really cautious about Europe, worried about inflation, energy prices, politics.
Pulling capital out in many cases.
Exactly, pulling back. Schwarzman announces Blackstone is committing $500 billion, $500 billion, into Europe over the next decade.
$500 billion, when others are heading for the exits.
That is thinking big and betting big, isn't it? It wasn't just an allocation tweak, it was a massive statement. A declaration, really. And the source gets into his rationale, which is crucial. It shows it's not recklessness. He's not driven by fear. He's not following the herd. He follows patterns. He seems to have this profound understanding that downturns, instability, market dislocations, that's precisely when assets get cheaper.
So while others see risk, he sees a discount.
He sees opportunity, assets trading below what he believes is their real long-term value, simply because of short-term fear or uncertainty. That counter-cyclical conviction is incredibly powerful.
That reminds me of the Hilton Hotels deal back in 2007. Another legendary example the sources bring up. Blackstone bought Hilton for $26 billion.
And the timing, crucially. They closed that deal literally right before the global financial crisis hit in 2008.
Right. Which, as the source says, seemed insane to most people at the time. Buying a huge hotel chain, a very cyclical business, just as the market peaks and then craters.
It looked like potentially catastrophic timing from the outside. Holding on to an asset like that when global travel just evaporated, it must have seemed incredibly risky.
Foolhardy, even, as you said earlier.
But they didn't panic. They didn't dump it at the bottom. They held on through the storm.
And the result? It's Wall Street legend now. They eventually exited, made over $14 billion in profit. It's always cited as one of the most successful private equity deals in history.
$14 billion profit on one deal after navigating the worst financial crisis in generations.
So what does that specific deal tell us? Living through that kind of stress, coming out with that result, it says a lot about the patience and conviction behind the bet big idea.
It really demonstrates a deep belief in market cycles and the understanding that creating real value in these alternative assets, PE, real estate, it's a long game. It shows their conviction wasn't based on market timing, but on a really rigorous, deep analysis of Hilton itself, its business, its assets, its potential.
They did the homework first.
Painstakingly, you have to assume. They saw the fundamental value, and then they had the strategic patience to ride out the storm and wait for the cycle to turn. That $14 billion wasn't luck. It was the payoff for conviction based on analysis plus incredible patience.
And that analytical rigor is key. The source stresses this. It's calculated boldness, not just risk-taking.
Exactly. It's not gambling. It's not shooting from the hip. It's built on data, deep diligence, and strategic patience. The boldness comes after the homework is done, and done thoroughly.
It's that combination, deep analysis plus the will to act decisively and at scale.
And when Blackstone moves like that, $500 billion to Europe, $26 billion for Hilton, the market notices. Competitors scramble. Governments pay attention.
They're not just taking small positions. The source says they make statements with billions behind them.
Right. It shapes the landscape, signals confidence, sets the agenda, often. And this idea of boldness, it goes beyond just finance for Schwarzman. There's that other quote. You don't get anywhere in life by being cautious. You get there by being bold, by being different.
So it's about having a unique perspective based on your analysis and then having the courage to act on it, even if it's against the current.
Precisely. And this think big, bet big idea, it's not just Schwarzman. The source makes it clear it's deeply embedded throughout the firm. It shapes how they train people, what's expected of leaders, how investment committees operate.
They're expected to look globally, find scale, build scalable strategies, aim for long-term dominance.
Thinking small is basically discouraged. And in today's world, with AI changing things, geopolitical uncertainty, inflation sticking around the source argues this mindset isn't just bold, it's actually necessary.
Necessary because why? Because the environment is turbulent.
Yes, and because, as the source puts it quite powerfully, Blackstone doesn't just survive turbulence, it feeds on it.
Yeah.
Market dislocation, uncertainty, crises, and so forth. These aren't just threats to be dodged. They're seen as environments where assets get mispriced, creating huge opportunities for those with capital and conviction.
So while others freeze, paralyzed by fear, Blackstone is actively looking for those discounts created by the fear.
They see turbulence as fertile ground. It really makes you pause, doesn't it? Think about your own world, your own work. Does your approach shy away from turbulence? Or are you set up to maybe feed on it, find opportunity in the chaos?
That's a challenging question. Okay, so we've got the foundational mindset. Now, the engine. How does Blackstone actually execute these huge, bold bets with the required precision? The source uses that striking metaphor.
Right, the Special Operations Force. Schwarzman apparently doesn't run Blackstone like a typical sprawling corporation. It's managed with the intensity, the discipline of a Special Forces unit.
Implying every move is deliberate, high stakes.
And flawless execution isn't just desired, it's required. Absolutely essential.
A Special Forces unit. That paints a vivid picture. What demands that level of intensity? Why is that necessary?
It boils down to the scale again. When you're managing $1.127 trillion, the margin for error is basically zero. A tiny mistake, a fraction of a percent off, that can mean billions in losses. So precision isn't a nice to have, it's survival, as the source puts it.
So every deal, every analysis, every meeting, it feels like a high-stakes operation. And Schwarzman's own mindset reinforces that quote about wanting wars.
Yeah, I don't want skirmishes.
Yeah.
I want wars, and I want to win them decisively.
Wow. That's an incredibly demanding standard. It suggests wanting total victory in their chosen battles.
It does, and it shows up in how they're structured. Deals apparently aren't shuffled between big, slow departments. They're handled by these elite pods.
Elite pods.
Small, cross-functional teams, laser-focused on one target, one opportunity, high concentration of expertise, very agile.
Makes sense. Small, fast, focused.
And every member of that pod needs to know the objective inside out, understand the risks, have backup plans. It's about empowering these small teams to move fast and effectively.
The source mentions the Refinitiv deal as a textbook example of this, the $20 billion acquisition.
Right, the financial data company. They bought it for $20 billion, then later sold it to the London Stock Exchange for over $27 billion.
So how does that fit the special forces doctrine?
It perfectly shows that playbook. Spot an underappreciated asset. Act quickly, decisively. $20 billion isn't small. Then, crucially, enhance the value operationally, streamline it, improve it, integrate it, and finally, execute a strategic exit at maximum scale. It wasn't just buy low, sell high. It was acquire, transform, divest, done with almost military precision.
And this discipline extends even to meetings. They're not for brainstorming.
Apparently not. The source says meetings are for presenting decisions that are already battle-tested.
Meaning the hard work, the debate, the analysis happens before the meeting.
Exactly. The expectation is you've done the rigorous analysis, challenged the assumptions, run the scenarios, the battle testing beforehand. Showing up unprepared with half-baked ideas, that's seen as wasting everyone's time, wasting capital. It reflects that high-stakes environment.
And the leadership style, described as tough but not tyrannical.
Right. Sets impossibly high standards, provides the tools and resources, but then holds people ruthlessly accountable for delivering results.
Sounds intense.
It clearly is.
Yeah.
And the source notes, this environment isn't for everyone, and that's by design. It naturally filters. People either rise to that challenge, thrive under that pressure, or they realize it's not the right place for them.
Based on that belief that pressure reveals truth.
Precisely. The idea is only those who can genuinely handle the heat, the pace, and the stakes involved in making billion-dollar bets belong in the room when those bets are being made.
It's a deliberate performance-based selection process.
And that operational intensity, that clarity of focus, is what allows Blackstone to move faster and more efficiently than many competitors, maybe even faster than government processes sometimes. It's that combination. War general's precision and a chess master's patience. A very dynamic, focused model.
Okay, so the engine is built for speed and precision, but it needs the right people driving it, which brings us to talent. Blackstone's hiring process sounds legendary, almost mythical in its difficulty.
It really does. The source mentions over 100,000 applicants a year for not that many jobs. They hire less than 1% of them.
Less than 1%. That's statistically harder than getting into Harvard or Stanford, or even the Navy SEALs.
That's what the numbers suggest. It's incredibly selective. And this obsession with who gets hired seems absolutely fundamental to Schwarzman's philosophy. His view is building a trillion-dollar firm starts with having the right people. Get that wrong, and nothing else matters as much.
And the right people, it's not just about being the smartest person in the room, is it?
Not at all. Raw intelligence is, table stakes in this world.
Yeah.
But the source emphasizes finding the right combination of smart, humble, resilient, and reliable. Intelligence is necessary, sure, but it's not enough on its own.
This is where that airport test comes in. Sounds kind of informal.
It does sound informal. The question is basically, would you want to be stuck for 6 hours at an airport next to this person?
Okay. Why does that matter for a high finance job?
Because, as the source explains, in these super high-pressure, high-stakes situations, billions on the line, brilliance, without emotional intelligence, without EQ, isn't just ineffective, it can be downright dangerous. Arrogance kills collaboration in those elite pods we talked about.
Right. Egos get in the way.
Toxic egos destroy trust. And trust, especially when you need to move fast and make huge commitments, is described as the oxygen of the firm. Without trust, the whole system breaks down under pressure.
So things like niceness, humility, reliability, they're not just soft skills, they're actually strategic requirements.
Exactly. Schwarzman himself is quoted saying something like, "You can teach someone finance, but you can't teach someone to be a good person."
That's powerful. So how do they filter for that, for both IQ and EQ?
They look really closely at how candidates react under pressure. They probe for genuine intellectual curiosity. Are they asking questions, trying to learn? They check if people are willing to admit what they don't know rather than bluffing. And they specifically look for people who aren't afraid to raise red flags or challenge ideas, even if it's uncomfortable. People focused on getting it right, not just being right.
That makes sense. Finding the truth seekers.
And the result, apparently, is teams that are unusually cohesive, even under all that stress. Because the culture, while demanding extreme performance, is also built on high integrity and mutual trust.
And the onboarding sounds intense, too. That quote.
Yeah, this is not a place where you can coast, you're here to grow, or you're in the wrong building. Sets the expectation immediately.
No hiding.
No hiding. But the flip side is, for those who do thrive, the culture offers unparalleled opportunity.
The source mentions many senior partners started as interns or in junior roles.
Which shows there's a real path. If you think big, take ownership, contribute, help others succeed, you can move up fast. And Schwarzman himself apparently leads by example, mentoring, training, really emphasizing that the firm is built on character just as much as capital.
So talent is chosen with surgical precision, then forged in the fire of real responsibility, because ultimately, who you hire is who you become.
It's a profound point for anyone building anything, really. It makes you ask yourself, how selective are you about who's in your room, who's on your team? Are you just looking at skills, or are you thinking about trust, resilience, integrity?
Definitely something to reflect on.
Okay.
Mindset, think big. Engine, special forces, fuel, elite talent. Now let's talk about the fortress, the investment strategy itself. It's not just about one big hit.
No, definitely not. Schwarzman didn't build this on single bets. He built a system. Layered, diversified, and designed to win across cycles. It's not about perfectly timing one thing. It's about having multiple ways to win, whatever the conditions.
The multiple engines metaphor the source uses?
That's a good way to put it. And the source lists them out. Private equity, real estate, credit, infrastructure, insurance, growth equity, tactical opportunities, environmental solutions, AI, and tech platforms. Each one of these is huge on its own.
They're like massive independent businesses under one roof.
Pretty much. And the combined effect is what creates this fortress. It can find opportunities and generate returns whether the market's booming, crashing, or just drifting sideways.
Because they have so many different ways to play.
They've built the capability to deploy capital and create value across such a wide spectrum of alternatives. They're almost always positioned somewhere interesting. Let's look at a few key engines.
Okay. Real estate. They're the largest commercial real estate owner in the world, right?
Portfolio over $330 billion. And their approach is classic Blackstone. Countercyclical, think big, buy when things look bad, improve operations, hold patiently, sell when the market's strong. And they were apparently very early movers into hot sectors like logistics and data centers, way before everyone else piled in.
Smart. Okay, private equity. That feels like their original business.
It's where you see that classic playbook applied to companies. Find an underperformer with potential, buy it, inject capital, bring in top managers, actively improve the business operations, strategy, add-on acquisitions. Hilton, Ancestry.com, those are examples of trying to fundamentally transform the business, not just financial tinkering.
Right. And credit. That division grew massively after 2008.
Hugely. When the traditional banks pulled back hard from lending because of regulations and risk aversion, Blackstone saw the gap and rushed in. Now Blackstone Credit manages hundreds of billions. They lend directly to companies, fund buyouts.
The shadow bank idea.
Yeah, though maybe private credit is a better term now. They provide the capital that banks used to, but often faster, more flexibly, maybe with fewer constraints in certain areas. They fill a huge void.
Makes sense. Infrastructure, betting on essential assets.
Exactly. Things society needs. Energy pipelines, ports, data networks, renewables. These tend to have long-term contracts, stable cash flows. Very attractive when the economy feels uncertain. And the source notes they're doubling down in Europe now, funding energy independence and digital infrastructure builds there.
Okay, so you have all these powerful, distinct engines. But what makes the whole system deadly effective, as the source puts it? It's the integration, cross-pollination.
That seems to be the secret sauce. The synergy. Insights from one division feed opportunities in another. Capital can flow between strategies, people might move between teams, a real estate deal might uncover a credit angle, a tech investment might boost an infrastructure project, a geopolitical insight from one team might trigger a move by another.
So it's not siloed. They're connecting the dots across the entire platform, playing multidimensional chess.
Thinking 10 moves ahead, as the source says, across different parts of the board simultaneously. The COVID period, 2020-2022, is given as a prime example. While others panicked, Blackstone's diversified structure let them pivot. They could buy distressed assets cheap in battered sectors.
Like maybe certain travel-related real estate or debt.
Right. while at the same time, they could cash out or lean into sectors that were booming because of the pandemic, like logistics or tech. That ability to shift capital dynamically based on the shock, that's the advantage of the structure.
And that resilience, that ability to perform across different unpredictable environments, that's why the big institutions love them. Pension funds, sovereign wealth funds.
Exactly. Those investors manage money for the very long term. They need partners who deliver returns, yes, but
Yeah.
also partners who can navigate the downturns, protect capital. They want resilience. Schwarzman, the source concludes, doesn't chase trends. He builds structures that can absorb shocks and convert them into upside.
Quietly restructuring the world, one sector at a time. It makes you think again. Are your strategies built just for sunshine? Or are they designed for resilience, ready to handle and maybe even benefit from the storms?
A really critical question in today's world.
Absolutely. Okay, thinking about resilience brings us to influence. Commanding this much capital, running this kind of machine, it naturally comes with significant power. And Schwartzman's influence, the source notes, goes well beyond finance.
It really does. His reach extends into government, education, diplomacy, and global policy circles. He operates on a much bigger stage than just Wall Street.
The source mentions him chairing Donald Trump's Strategic and Policy Forum back in 2017. That sent a message, didn't it?
It certainly signaled he's a player in policy discussions, not just reacting to them.
But the source is careful to say his influence isn't really partisan. It's more about economic weight.
Yeah, economic gravity is the phrase used. When you control over $1 trillion in global assets, people in power across the political spectrum, both in the U.S. and globally, tend to listen when you talk about markets, investment, the economy. He's advised leaders of all stripes.
And this influence shows up in major philanthropic and educational initiatives, too.
Big ones. $350 million to MIT for AI research and ethics. That's tackling cutting-edge tech and its societal impact. $150 million to Yale. But the most prominent is probably the Schwarzman Scholars Program.
The $500 million endowment at Tsinghua University in Beijing, a global Rhodes-style scholarship.
And its mission is explicitly strategic. Train future global leaders with a deep understanding of China-West relations. It's not just charity. The source calls it strategic influence, building soft power by shaping relationships among the next generation of leaders in a critical global dynamic.
And let's circle back to those huge personal earnings, that $916 million in 2024. The source frames this not just as wealth, but as a measure of his power and the success of the system he built.
It's a direct outcome. That income, more than the GDP of some small nations, as the source points out, combined with owning nearly 19% of Blackstone stock, it gives him immense leverage. He can genuinely sway markets, deals, and regulations.
Yet he's described as a quiet operator, not always in the spotlight.
Right. He doesn't seem to crave constant media attention. But he has this ability to convene the powerful, call central bankers, broker huge deals, gather global leaders privately. His philosophy on influence is telling. Influence compounds when it's used sparingly but strategically.
Use it when it counts.
Exactly.
Yeah.
Be deliberate. The source suggests he's respected partly because he doesn't just follow trends. He helps build the platforms where future trends emerge.
Building platforms. That connects to how he structured Blackstone itself as a public company, doesn't it?
Absolutely. The source makes it clear that making Blackstone public was part of his long-term vision from early on. A deliberate choice to create a structure that could scale almost limitlessly by tapping public capital markets.
Taking a private equity firm public in 2007, that was considered radical then, wasn't it?
Groundbreaking for the PE world at the time. Public markets weren't used to valuing firms based so heavily on performance fees and carried interest. But Schwarzman saw the IPO as unlocking flexibility and growth potential that staying purely private would limit.
Access to public equity, raising billions relatively cheaply, attracting big institutional investors, rewarding shareholders long term.
The IPO raised over $4 billion right away, fueling expansion. And while he benefited personally, the strategic goal was clearly building a bigger, more permanent capital-raising machine. But he didn't stop there. In 2019, he made another, even rarer move for a firm like Blackstone.
Converting from a partnership to a standard C corporation.
That was a big structural shift. The why was strategic. A C-Corp is the standard format most investors understand. Crucially, it made Blackstone stock easily investable by giant index funds and potentially millions of ordinary investors who couldn't easily hold the old partnership units.
So it massively expanded the potential pool of shareholders.
Dramatically, from maybe thousands of sophisticated partners to potentially millions of public market investors. And the stock reportedly jumped after that change.
And this C-Corp structure also created more stable platform for dividends.
Exactly. More predictable structure for distributing profits, which benefits all shareholders, including Schwarzman, obviously. That $916 million income in 2024, mostly dividends, 777 mm, plus fees, 139 mm, the source presents that as a result of strategic design, not luck.
It's the engineered outcome of building this cash-generating fortress.
Precisely. Multiple income streams, scalable fees on massive assets, high client retention, consistent performance across strategies. And unlike some firms that just reinvest everything, Schwartzman seems to believe strongly in rewarding investors visibly, regularly, and generously.
There's that quote, "If you build trust with your shareholders, they will fund your future again and again."
That commitment builds loyalty, a strong reputation, and makes it easier to raise capital for the next big thing. So Blackstone is this publicly traded engine commanding global capital, and it's structured to pay handsomely for it. Schwarzman realized, maybe paradoxically, that the best way to stay in control and grow such a giant entity was to share it the right way, through a public structure that aligns interests.
Okay, that's a comprehensive look at the machine. We've hit the mindset, the operations, the talent, strategy, the influence, the structure. Let's distill this. What are the key takeaways someone listening could potentially apply, even if they're not in finance?
The source boils it down well. 6 core lessons, really. First, think big, bet bigger. Don't wait for perfect certainty. When a genuinely rare opportunity appears and others are hesitant, act decisively at scale. That quote again. Opportunities are rare. When you see one go all in, makes you ask, are you spotting your rare opportunities?
Yeah.
And are you truly committing?
Second, treat every decision like it matters. Discipline beats chaos. Approach your big challenges with focus, rigor, like you're in a war room. Think about your own decisions. Are you bringing enough discipline to the ones that really count?
Third, choose people not just for talent, but for trust. Your team, your collaborators, build on integrity, resilience. Culture is critical. That niceness, that EQ, it's strategic. Who's in your room? Are you weighing character and trust alongside skill?
Fourth, diversify not just your portfolio, but your thinking. Don't get stuck on one approach, one engine. Build systems and strategies that can adapt, that are resilient across different environments. Yeah. Are your own strategies built just for smooth sailing, or can they handle, maybe even leverage turbulence?
Fifth, use influence sparingly, but intentionally. Play the long game. Real influence isn't always about being the loudest or most visible. It's often about strategic timing, positioning, using your leverage deliberately when it matters most. How are you trying to influence outcomes? Is it focused and strategic?
And sixth, wealth is not the end goal. It's the platform. Accumulating resources is one thing, but maybe the real measure is what you build with those resources. Investing in people, the future, lasting structures. Are your goals just about accumulation, or are you using what you have as a platform for something bigger?
Taken together, these lessons from the Schwarzman and Blackstone story offer a pretty powerful roadmap for building something significant, resilient, and impactful, really in any field.
It really is a fascinating narrative. It's about strategic power, building trust, which takes time and consistency, and how that long-term calculated thinking beats reacting to short-term noise again and again. He didn't build this by following fads. He built it by seeing things differently, acting boldly, building an elite and high-integrity team, and designing for resilience.
Yeah, in a world that often feels obsessed with the next quarter's results, the decades-long construction of Blackstone really stands out. It's a testament to vision, discipline, patience, and that relentless pursuit of excellence.
So maybe the final thought for you listening to this deep dive is this. What does it mean to build your own Blackstone? Not necessarily in finance, but in whatever you do. How can you apply these principles, calculated boldness, disciplined execution, careful team building, multifaceted strategy, intentional influence to your own ambitions?
How can you design your approach not just to survive the inevitable turbulence, but maybe even feed on it? How do you build something truly resilient, something with lasting impact, whatever that means for you?
Something to think about. This deep dive is complete.